It's a great time we meet again for a session of advanced financial reporting. So for today, we are going to do a question of earnings per share. That is according to International Accounting Standards 33. So we have done a lot of questions concerning this earnings per share. So we have done on how to do basic earnings per share and at the same time diluted earnings per share, of which we have done questions where we have a right issue. We have done questions where we have share split, and we have done some few questions where we have bonus issue. So now, for the question I'm going to do is the one which has a reverse split, and at the same time, it has a bonus issue, so that we can be able to wind up for this relevant topic of International Accounting Standards 33. And those are all the concepts which are supposed to be tested in the earnings per share. So that is what I've said, that you can find a question where you have a right issue, bonus issue, share split, and a reverse split. But you can't find all those items in a question, but you can find two or maybe one or two items in a question. So you need to know how to deal with them in each question, which might be tested in your exam scenario and in any practical world whereby you will be dealing with earnings per share. So in order to illustrate more about the reverse split and the bonus issue, let us check a question which was tested in November 2015, question 4. That is from the paper of Advanced Financial Reporting, section 6, CPA. So this is the relevant question. So this is the question. So question 4C, this is November 2015. This was immediately after the change of the current syllabus, which they are going to change now coming December 2021. With the rollout will be next month. Then now they will be able to test you with the new syllabus coming December. So this is immediately after they changed the syllabus last 5 years ago. So they were saying that Winam Limited, a limited company, has an authorized share capital of shillings 4,000, comprising 600 million ordinary shares, each of shillings 5 per value, and 50 million 10% convertible preference shares, each of shillings 20 per value. So you can see here we have an authorized share capital of 4,000. So in terms of shillings, so comprising what? So it was made up of 600 million ordinary shares of shillings 5. So if I take 600 times 5 to get the total value of ordinary shares, I can see I will get 3,000. So 600 times 5, that is 3,000. And also 50 million, 10% convertible preference shares, each of shillings 20. So if I take 50, remember we have here again preference shares. So 50 times 20 is 1,000. So the 3,000 plus the 1,000, I'm getting the 4,000. So that is what was constituted in the 4,000. So the 4,000 constituted 600 ordinary shares of 5 per value and 50 million 10% convertible preference shares of shillings 20 per value. Then they say that on 1st January 2013, the company had in issue 160 million ordinary shares. So what they issued out of the 600 is 160 shares. That is ordinary. And out of the 50 preference shares, they issued 30. That is 30 million, 10% convertible preference shares. So what about these preference shares? All preference shares were fully paid, while only 100 million ordinary shares were fully paid. The balance of the shares being 80% paid. The foreign transactions took place in the year ended 31st December 2013 and 31st December 2014. So note one, they are saying the party paid
ordinary shares of shillings 5 per value was fully paid on 1st April 2013. Number 2, on 1st June 2013, the company issued for consideration 72 million ordinary shares of shillings 5 per value at shillings 8 each in full settlement. The market price of the ordinary shares on this day being shillings 10 per value. Number 3, on 1st September 2013, the company issued 48 million ordinary shares of shillings 5 each at fair value of shillings 12 per value, not per value but per share, in settlement of the purchase consideration on the acquisition of property. Number 4, on 1st March 2014, the company issued one fully paid bonus share for every 5 ordinary shares outstanding as at 31st December 2013. Number 5, due to raw market price per ordinary share at the securities exchange, the company decided to effect a consolidation of the shares, reverse split, and issued one new ordinary shares of shillings 10 per value for every 2 outstanding and the fully paid ordinary shares of shillings 5 per value. This was done 1st August 2014. Number 6, on 1st October 2014, holders of 10 million, 10% convertible preference shares converted these shares into ordinary shares. The preference shares were convertible into 8 fully paid ordinary shares of shillings 5 for every 2 fully paid 10% preference shares of shillings 20 each. An appropriate adjustment for the number of ordinary shares issuable on conversion of preference shares is to be effected for any ordinary share split or combination that may be carried out. Preference shareholders are entitled to dividends up to the date of conversion of the shares. The company made a net profit after tax of 225.75 million in the year ended 31st December 2013 and 262.6 in the year ended 31st December 2014. So you are required to do basic earnings per share for each of the 2 years ended 31st December 2013 and 31st December 2014. The restated basic earnings per share, that is the second requirement, for the year ended 31st December 2013 and as at 31st December 2014. So without wastage of time reading on the question, we can go direct and do something concerning what was required. And that is how you can only get marks under the earnings per share. So of which we know that the first requirement is all about basic earnings per share. And the basic earnings per share, we know that, I can write in short, basic earnings per share, which I call it PEPS, is equals to powers of our nodes. So powers of our nodes. So powers is all about profit attributable to ordinary shareholders, and one is the weighted average number of ordinary shares. So to start with powers, so that is powers. And remember for this question, it is 2013 and 2014. 2013, 2014. So we have to start from reported profit after tax. So reported profit after tax. And you know that obvious, for the basic earnings per share, we use the profit from both continuing operations and the discontinued. So even if they give you the 2 separate profits, you have to get the total. If there's a one from continuing operations and the one from discontinued. But on this scenario, it's just a profit you are given as one figure for the 2 years respectively. So that is according to note 7. The company made a net profit after tax of 225.75 in the year ended 31st December 2013 and 262.6 in the year ended 31st December 2014. So I can be able to record those two. So 225, that is 225.75, and I have 262.6. Then after that, we have to raise profit attributable to non-controlling interest, but there's none. There was no profit attributable to non-controlling interest.
Then after that, we have now to raise preference dividends. We have to raise preference dividends. So I write in short the preference dividend. So of which concerning the preference dividends, when they are converted, you have to pay up to the conversion date. You have to pay the dividends up to the conversion date. Then now the one which is unconverted, we consider for the entire period. So like now we move to the note 6. That is where I have the relevant preference dividends, the convertible. They say that on 1st October 2014, holders of 10 million, 10% convertible preference shares converted these shares. And remember that the total preference shares which were issued, before even I talk about the convertible, the total preference shares which were issued is the 50 million. Not the 50 million, but the 30 million. So the total preference shares which were issued is 30. Because they say here, on 1st January 2013, the company had in issue 160 million ordinary shares and 30 million 10% convertible preference shares. So which means that out of the 600 ordinary, 160 were issued. Out of the 50 preference, 30 were issued. So we consider the issued. So out of the 30, as at January 2013, that is from the 2013, what happened according to note 6? On 1st October 2014, on 1st October 2014, what they did is that 10 million, 10% convertible preference shares converted these shares into ordinary. So the preference shares were convertible into 8 fully paid ordinary shares of shillings 5 for every 2 fully paid 10% preference shares of shillings 20 each. An appropriate adjustment for the number of ordinary shares issuable on conversion of preference shares to be effected for any ordinary share split or consolidation that may be carried out. Preference shareholders are entitled to dividends up to the date of conversion of the shares. So we have to consider the converted first, then I will consider the unconverted. So the converted, remember, occurred in 2014 and it's just 10 million. So which means that up to the date of conversion, that is 9 months, that is from January to 1st October. So that is like from January to the end of September. So that is 9 months. So I will take the unconverted. So for the unconverted, and this one is in 2014. So the unconverted, remember that I will take 10% is the contractual rate times the 10 times 20 shillings. Remember that the per preference share was 20. So one preference share was trading at 20, and the 10 million is the preference shares were given. Then the period we have to consider 9 months. So 9 out of 12, that is up to the date of conversion. So this is convertible, not unconvertible. Sorry for that. So this is the one which is converted. Then unconverted. So unconverted now, let's talk about now 2013 and the 2014. Remember this was in 2014. So for 2013, remember that I will talk about the 10% of the total value of the preference shares which was issued, which is the 30 times shillings 20 times the shillings 20. In 2013, there was no conversion, but where conversion occurred is in 2014. So for 2014, remember that they converted 10. So the unconverted is 20. The unconverted is 20. So 10 shillings, 20. Then obvious, you know that this period could have been 12 out of 12. So that is 5. So that is how you would have dealt with
For 2014, that was convertible. So of which 10 million was converted on 1st October. So that is why you can say I've said 10% of the 10 which was converted, 10 shillings 20. Each preference shares was going at 20. Remember, dividends are paid out of the total value, not the number of shares. Then up to the date of conversion, 1st October, it is by the end of September, 9 months. Then when I come to unconverted, remember 2013, there was no conversion. That is why I've considered the total security, the 30. Then for 2014, after they have converted 10, remember that what remained unconverted is the 20. So the 20 is just 30 minus 10. So that you do the necessary 10% times 20 shillings times 12 out of 12. So after all the computation, I can be able to get the pause for 2013 of 165.75, and this one is at 207.6. So that once we are done with the pause, which is the profit attributable to ordinary shareholders, the next part we have to move to is the weighted average number of ordinary shares, of which I said that for any question we are doing, when doing one-nose, weighted average number of ordinary shares, what you have to check if there is an element of right issue, because obvious right issue requires you to use a formula when you are doing the weighted average number of ordinary shares. But since we read the question, I don't think if we came across an element of right issue, so which means that there was no right issue. So what we are supposed to do now is just the determination of the one-nose using the relevant ordinary shares which were issued by just considering the timing from which they were issued to the end of the year. So that is what we call weighing. So we just weigh as per the time factor to determine the weighted average number of ordinary shares. So let us do that. So that is one-nose, that is now one-nose. So which means that I will start with 2013. So I have to draw everything here on the table. So date, details. I have to talk about shares. So once I have my shares, I have to weigh. Then once I've done with weighing, I will be able to get my ounce of one-nose. So 2013 starts from January 2013. So balance brought down. So as of January 2013, remember that the number of ordinary shares which were issued from January 2013 is 100 as given here. On 1st January 2013, the company had in issue. So it was issuing 160, not 100. It's 160. So on 1st January 2013, the company had in issue 160 ordinary shares and 30 million 10% convertible preference shares. But now what about these 160 ordinary? They came and said all preference shares were fully paid, while only 100 ordinary shares were fully paid. Only 100 were fully paid. So I have to consider the one first which are fully paid. Yes, by the end of the period, you will find that I've recorded the total 116, but I will be recording as according to the question. So I have the one which are fully paid. The 100 was fully paid. So I have to wait for the entire period because from January to the end of the year. Then they say the balance now is 60 because the total value of the ordinary shares which they issued is 160. So the balance, which means is 60. So because already we have recorded the 100 which were fully paid, then they say the balance of the shares being 80% paid. So the 60, which is the balance, being 80% paid. So again, we have to consider the one which are partly paid. So the balance, so being 80% paid, so the 60.
So this one I get 48 because 8 times 6 is 48. Then again, it's from January. So that remains to be 48. Then now, remember that now what is remaining is concerning 20%. 20% of 60. So 20% of 60 to make it now that everything has been paid. So 20% of 60 is what is remaining. The 12 shares is what has not been paid. So that is what they went and said under additional information number 1. And what you need to know is that the ordinary shares were trading at shillings 5. That is according to the statement they provided at the start of this question. So the 600 ordinary shares of shillings 5 per value. So what we need to know is that the ordinary shares were trading at 5 per value. So the par value of the ordinary shares were 5. So if you go to additional information number 1, they say the part 3 paid ordinary shares of shillings 5 per value were fully paid now on 1st April 2013. On 1st April 2013. So you will come here and record 1st April 2013. 1st April 2013. So now part 3 paid, now fully paid. Now fully paid. Now fully paid. So we have said that the balance was, remember that now the one which was remaining is 20% of the 60. The 20% of 60. So which is 12. So from April to the end of the year, those are around 9 months. So you talk about 9 over 12. So which remains to be 9. So we continue with additional information number 2, since we are done up to additional information number 1. So additional information number 2, they say on 1st June 2013, the company issued for consideration 72 million ordinary shares of shillings 5 per value at shillings 8 each in full settlement. So the market price of the ordinary shares on this day being shillings 10 per value. That is per share, not per value, per share. So on 1st June 2013, the company issued for consideration. So there is something they were purchasing, so they issued shares, 72 million shares of 5 per value at shillings 8 in full settlement. So the market price of the ordinary shares, on this day being 10. So these 72 million ordinary shares were trading in the market at 10. But remember that they were issued at 8. So we have to equate to determine how many shares that were issued at 8, because they were never issued at full market price. They were never issued at full market price because the market price is 10 and they were issued at 8. So we have to do something here. And this occurred on the 1st June. So 1st June 2013. So new issue. So this one we have to equate this way. Remember that the 72 shares in the market, they were trading at 10. Of which they were issued at 8. So we have to talk about what about 8? Because they were never issued at full market price. They were issued at 8. Their par value was 5. But the market price was 10. So they were never issued at full market price. So 8 times 72 over 10. So if I use my calculator here, I'm getting 57.6. 57.6. So weighing from June to the end of the year, from June to the end of the year is 7 out of 12. So 57.6 times 7 out of 12. So that is 33.6. That is 33.6. So we continue with another additional information. Before I make more clarification, maybe if there will be one. So number 4, On 1st March 2013, not the 3. On 1st September 2013, that is not the 3. On 1st September 2013, the company issued 48 ordinary shares of shillings 5 each at a fair value of shillings 12 per share in settlement of the purchase consideration on the acquisition of property. So when they were acquiring property, issued shares, 48 ordinary shares, that is 48 million ordinary shares of shillings 5. So that is the par value. But they were issued at a full market price of 12. So you can be able to differentiate between node 2 and the 3 because node 2, the 72 ordinary shares of a par value of shillings 5 were issued at 8, but the market price was 10. That is what I said first. 72 is equals to 10. What about this 8? Because they were never issued at market price. But for node 3, the 48 ordinary of shillings 5 were issued at a fair value, at a market price, at a full market price of 12. So what I will come here and record is to say 1st September, the first date, 1st September, that is 1st September 2013. So 1st September 2013, I will say new issue. So I will just record the 48 because they were issued at market price, at full market price of 12. So from September to the end of the year is 4 months. That is 4 over 12. So if you multiply the 2, you get 16. So you are supposed to get 16. So we are getting to 6.6. So I mean that now we can be able to get now basic earnings per share. So basic earnings per share 2013. So the basic earnings per share 2013 is all about the powers of the one-nose. So of which the powers we already got it from our first requirement or the first computation, not the requirement. And the first computation was this one. So we got 165.75. That is for 2013. 165.75. 165.75. So 165.75 you divide with 206.6. So that is shillings worth per share. Shillings worth per share. So if I take 165.75, you divide with 206.6. So I'm getting 0. I'm getting 0.80. That is 0.80 per share. So we can do now the one-offs for 2014 very fast. Again, in this question, there was no right issue. Even in the year 2014, there was none. So which means that in 2014, again, we do the same. The weighing of shares. So date, details. We talk about shares. So after that, we weigh. Then we get the answer, there were no's. We get the answer, there were no's. So which means that the date, obviously, is the start of the year, which is January 2014. So for now, for January 2014, to start with, is all about the shares we have here from 2013. So the shares, so we have to add this column of shares so that we determine the balance per down. So the 100 plus 48, that is 148 plus 12 plus 57.6 plus 48. So I'm getting 265.6. So this is 265.6. So the 265.6. So 265.6. So that is the balance per down. So 265.6. So the 265.6. And this one, obviously, you weigh from the start of the year to the end for the entire period, that is throughout the year. So we get 265.6. 265.6. So after that, we talk about the second period now, which is there in the 2014. So remember, we had already done up to note 3. So we move to note 4. If I'm not wrong, we have to move to note 4. So note 4, yes, that is note 4. On 1st March 2014, the company issued one fully paid bonus share for every 5 ordinary shares issued as at 31st December 2013. So there's a bonus which occurred. In which proportion? The company issued one fully paid bonus for every 5 ordinary outstanding as at 31st December 2013. So remember that 31st December 2013 is the end of the previous year. So which means that is the shares which were there as at the start of the financial year 2014. So this bonus, you know that bonus is all about the shares which are given to the existing shareholders on a certain proportion at no consideration. That is for free. So on this consideration was, for every 5 you have, you are given 1 for free. So we have to determine the number of shares which the company issued through bonus. So using the proportion. So that is what occurred on 1st March 2014. So bonus issue. So that is bonus issue. So there was a bonus issue. So the bonus was in terms of 1 for every 5 of the shares which were held, 265.6. This is the one which were held, 265.6. So if you divide by that, I'm getting 53.12. So 53.12. And remember that when I talked about bonus, when I was introducing bonus at the start of the topic, I said that so the shares which are issued through bonus, you weigh them from the earliest reported period. So now, like now, this bonus, it's based on the shares which were there from January. So you weigh them from January. So you don't have to consider from the time the bonus took place, but you consider from the time the shares on which they are based their argument on were incorporated in the capital structure. So these shares were there from the initial period, that is from the start of the year. So that is 12 out of 12. So that is what I have here, 53.12. So once we are done with that, we move to additional information number 5. We move to additional information next, which is 5. So additional information number 5 was concerning reverse split. Reverse split. So, and reverse split, we need to know the proportion, and the proportion is always constant, which is 1 to 2. So due to low market price per ordinary shares at the securities exchange, the company decided to effect a consolidation of the shares, a reverse split, and issued one new ordinary share of shillings 10 per value for every 2 outstanding, and the fully paid ordinary shares of shillings 5 per value. This was done in 1st August 2014. So we have to record that date, 1st August 2014. So what occurred here is all about concerning reverse split. Reverse split. So what took place there is a reverse split. So a reverse split occurs when we see that our shares are cheaper. So since our shares are cheaper, we can accept now to effect a consolidation effect to make them expensive. Of which, remember that our ordinary shares were trading at 5 per value. So if we do a reverse split, they will be trading now at shillings 10. So for every 2 you consolidate, so that it starts trading at a higher price. So in terms of a reverse, is the opposite of split. So for reverse split, the shares were trading at a lower price. So we need to make them expensive. For a share split, the shares were expensive. So we need to make them cheaper. So when we are doing a reverse split, like now you can see they say due to raw market price, even they have told you for ordinary shares at the securities exchange, the company decided to effect a consolidation of shares, reverse split, and issued one new shares of shillings 5 per value. And you know that our per value initially was 5. So if they do a reverse split, obviously it will double. The per value will change to 10. For every 2 outstanding, fully paid ordinary of shillings, 5 per value. So remember that we have to reverse the shares which we have up to August. So that is what you have first to do before you consider anything else. So because now the shares of 265.6 and 53.12 were trading at 5. So we need to reverse them to make them expensive. So I will take 265, not 256. This is 265. The first one from January, 265.6 plus the 53.12. That is from March. Then remember that we reverse. When we reverse it, you multiply with a half. You multiply with a half. You multiply with a half. Because it's the same way saying, right? You say this. The proportion was 1 for every 2 which are there. And we know that the total which is there is 265.6 plus the 53.12. So that is what I have done here. So it's like I have equated. So the total of 265.6 plus 53.12. So we need to determine when they were reversing, how they reversed. And remember that when you reverse your share, when you do a reverse split, that is when you reverse. There is a reduction of the number of shares, but at the same time, the par value increases. So there will be a decrease in terms of the shares. So using my calculator here, that is 265.6 plus 53.12. You divide by 2. I'm getting 159.36. So 159.36. And remember that since the reverse split occurs in August, we don't have to consider from August when doing your weighing. So you consider from the time these shares were incorporated in the capital structure. So remember that the bonus obviously is weighed from the initial period, which is January. And so which means that obvious, this one will be 12 out of 12. Because even this bonus, we weighed it from the initial period. Because it was based on the shares of 265.6. So which means that again, these two, the 265.6 and the 53.12, we have to weigh them from the initial period when they were incorporated in the capital structure. So which remains to be 159.36. So this one I've said you have to subtract. The reverse split will be reducing your value, but increasing the par value. So that is what you have to do. So when you weigh them from the initial period. Then for the reverse, you have to subtract. Because it increases the par value and reduces the number of shares. So we have to continue with another additional information since we are done with the aspect of a reverse split. So once I'm done with the reverse split, I have to move now to note 6. So note 6, it was concerning preference shares, the convertible. So remember that we said when I'm doing basic earnings per share, we always, specifically when I'm doing basic earnings per share and I'm doing the WANOs, the weighted average number of ordinary shares, we weigh ordinary shares. So why am I considering now convertible preference shares? So I will consider convertible preference shares if it's only converted. So if it's specifically converted to ordinary shares. So remember that the preference shares, the total value was 30 million. So out of the 30, in 2014, 10 million was converted to ordinary shares. That is what they said in note 6. On 1st October 2014, holders of 10 million, 10% convertible preference shares, converted these shares into ordinary. So, and obviously you have to be provided with the proportion on which they converted. That is why they went ahead and said the preference shares were convertible into 8 fully paid ordinary shares of shillings 5 for every 2 fully paid 10% preference. So this proportion is in terms of shares. Even the convertible was in terms of shares, which is fine. So it's all about 8 ordinary is equals to 2 preference. What about 10? So 8. So what you will be doing after equating, you will do this. So it was occurred on 1st October 2014. So that is a conversion. So this is conversion. So conversion, I have said 8 ordinary is equals to 2 preference. So what about the 10 preference? So this was in terms of shares, so which is fine. So I have to take 10 times 8 over 2. So, and remember that now, you have to consider the aspect of the reverse split. So when was this security, that is the convertible preference shares, issued? Was it after the reverse or before? When was it issued? So it was 1st October. So on 1st October, so I have to consider here something. So here we have to consider the reverse by multiplying by half, because this one was after August. That is, it was converted to ordinary shares. So the 10 million was converted. That is after August 2014, because that is the period of reverse. So August 2014. So, and this one was after. So for anything coming after, you have to reverse because it has not been reversed, which is the opposite of a share split. I think you remember that. So if you take 10 times 8, divide by 2, that is 40. 40 divided by half. So you get 20. So yeah, I'm getting 20. So from October to the end of the year, those are 3 months. So 3 out of 12. So if I consider 20 divided by a quarter, because 3 over 12 is like a quarter. So that is 5. That is 5. That is fine. So I have to add my last column there of 1 to get the answer. So 265.6 plus 53.12. 53.12 minus 159. I told you for the reverse, you have to subtract. It reduces the number of shares while increasing the price of the share. So you get the 164.36. So 164.36. So 164.36. So I can be able to say that the basic earnings per share 2014 So basic earnings per share 2014. It's all about the pulse of our nose. And for the pulse, we did it early enough at the start of the question, of which we got 207.6. 207.6. So 207.6. So 207.6 you divide with 164.36. 164.36. So that is shillings what per share. So if I take my 207.6, I divide with the answer. So I'm getting 1.26. So 1.26 per share. 1.26 per share. So once we are done with the first part of the question, we can move to the second part of this question. And the second part of the question was concerning restated earnings per share for the year 31st December 2013 as at 31st December 2014. So when you are doing restated earnings per share, we call it comparative earnings per share. So it's all about measuring the profitability of the entity using 2 consecutive periods. And this one will be computed with the assumptions. What if items like bonus, issue, right issue, share split, and reverse split are in the present year, of which now we are go with the assumption they were in the previous year. So what I'm trying to say is all about is that for you to do restated earnings per share, so restated EPS. So restated EPS is all about comparative EPS. So you do the comparative to the comparative EPS. So the comparative EPS, so to measure about profitability for the 2 periods. So profitability. So you compute with the assumptions with what if. So it goes with the assumption with the word what if. What if the things like bonus, what if things like bonus issue, right issue, share split, if they are present, that is share split, and we call it a reverse split. So these are 4. So what if the bonus issue, right issue, share split, reverse split, if they were present in the current year, now we go with the assumptions what if they occurred in the previous year. What if they occurred in the previous year? What if they occurred in the previous period? In the previous year. Like now, our financial year for the current year ends December. I think that is correct. We have 2 years. So the current year is 2014. The current year is 31st December 2014. According to the question, its current year is 31st December 2014. So which means our financial year starts January 2014. So this is the current year for this question. So the previous year, is concerning 2013, according to the question. 2013. So 31st, that is 31st December 2013. So which starts 1st January 2013. So what occurred in this question is 2 items, bonus and the reverse split. And you can see both of them, I think they occurred in 2014. Obvious, you will be told they occurred in 2014. So we can check and confirm. Like now, note 4, there was a bonus. On 1st March 2014, the company issued 1 fully paid bonus for 5 ordinary. So there's this bonus occurred 2014 March. So that was the first one which occurred 2014. Even this reverse split, it occurred 1st August 2014.
So which means that both the bonus and reverse, which was in the question, occurred in this year. So bonus and we have reverse. They occurred in those periods. Now you will be computing now you are restating with the assumption. So you will be doing your restated EPS with the assumptions. What if they were there in 2013? So which means that they will change your weighted average number of ordinary shares in 2013. Let us do that. So I will come here and say, so restated EPS. So restated EPS. So I have to start with 1 of 2013. So the 1 of 2013, so which means that 1 of 2013, we have it already. So you remember very well we did 1 of 2013, and the 1 of 2013 was 206.6. I'm just speaking from what we did, 206.6. So 206.6. So that is 2013. So now what I've said is that we are computing the new EPS for 2013, assuming that the bonus and the reverse split, which occurred in 2014, occurred in the 2013. And remember that the bonus was the first one. So I have to start with the bonus because the bonus was the first one, which occurred on March in the year 2014. Then a reverse split came in August. So I have to start even in 2013 now, even if with the assumption, I have to start with the bonus. So assuming, so I have to assume bonus 2013. So the same proportion, 1 for every 5. So 1 for every 5, it was the proportion, times now the 206.6. 206.6 is that one knows. I think you know where I'm getting 1 for every 5. That was the proportion of the bonus which you were given, according to note 4. The company issued 1 free pay bonus for every 5 ordinary shares outstanding as at 31st December 2013. So if I use my calculator, that is 206.6 divided by 5, I'm getting 41.32. 41.32. The next thing which was coming in is all about reverse. So assuming reverse split 2013. So for the reverse, remember I have to use now the total because now the number of shares had increased because now the bonus was had occurred, that is. So I have to take 206.6. I have to add now with the bonus, the shares through bonus, 41.32. So 41.32. Then I have to reverse this. You reverse, you have to multiply with half. So if I take 206.6 plus 41.32, so it's like I divide by 2, I'm getting 123.96. And obviously, you remember that I said when we do a reverse, it reduces the number of shares, but increasing the par value of the shares. So which means that even now I get the total is 123.96 because I have taken, it's like the half. So if you take the 2 minus this, 123.96. So basic earnings per share now 2013. Basic EPS 2013. After now the adjustment we have done is equals to, remember that my pause will be constant. That one can never be affected. So our pause was 165.75. The profit cannot be affected in any way by the bonus or the reverse. It will remain to be the same. So 165.75. So that is 165.75 then divided by 123.96. Now, after these changes we have made with the assumptions, what if the two items, bonus and reverse split, occurred in 2013? So what I'm getting is all about 165.75 divided by 123.96. I'm getting 1 point, so shillings 1.34 per share. So this is all about the earnings per share for 2013. If the bonus issue and the reverse split was there in 2013. So if we compare with 2014, so for 2014, our earnings per share was, so for 2014, we got 1.26. Yes, it was 1.26. This one. So in real sense, in 2014, when the bonus was there and the reverse split was there, this was our earnings per share. But if we go with the assumption now, what if now the same thing which occurred in 2014 was there in 2013? What could have happened to our earnings per share? So our earnings per share could have been 1.34. So this shows that the company performance could have slightly decreased in 2014 compared to 2013, because now 2013 is more than 2014. So we can comment and say that the company's performance, so the company's performance slightly decreased. So the company's performance slightly decreased in 2014 compared to 2013. Compared to 2013. And that marks the end of this question. And it marks the end of the topic, earnings per share, because we have already captured all the concepts which the examiner can be able to test you in any question of earnings per share. So this marks the end of today's session. That is for the earnings per share, whereby we have covered the concept of reverse split and a bonus issue. So I urge you that you continue subscribing to the channel and clicking the notification button so that you will be notified once I upload other videos concerning CPA and generally accounting. So again, you are welcome to join our online classes, the real-time online classes, the live classes, which are ongoing for the preparation of the coming exams. That is for the August sitting concerning the old syllabus before we move to the new syllabus, which will be coming December sitting. So have a nice time.